No clickbait title, no doom and gloom, just an educational episode of the Ozbourne Foreman show. Today I'm going to break down an AGM, an annual general meeting, and how you can use these to your advantage so that you can increase your knowledge when investing in the stock market. And all I ask is that you drop one of these for the YouTube algorithm. Although firstly, I'd like to talk about the proposed and now put into action Kickstarter scheme, which incentivizes businesses to employ under 25s. I'm going to give my views on why I don't actually think this will be that beneficial for the economy. So the UK government launched a £2 billion scheme in which they are targeting under 25-year-olds who are currently on universal credit. Effectively, what the government will do will cover national insurance contributions for the employer. They will also pay wages of up to minimum wage on 25 hours a week, or roughly between £161 to £205 per week, in which the employer could top this up further if they would like. And this is planned to run until December 2021. However, I don't feel that this will be as effective as the government would like, but I do believe it is a step in the correct direction. Currently, I feel that the issue in the job economy is due to the redundancies made of high-skill employees. And this to me would mean people in head offices, or even those just working in office blocks. These are less entry-level jobs, and therefore what's happening is that businesses have to make people redundant or cut back on their employees. So the idea that they will therefore leave the employees working on the ground, those that are actually bringing money into the business. An example being perhaps a cash or store assistant, in which they are actively dealing with customers and putting money through the till. Whereas it's a lot harder to get rid of these employees than it would be to get rid of some head office employees that dealt with management. Therefore, effectively what's happening in our economy is that there is a larger proportion of high-skilled employees that have been made redundant, and therefore an oversupply of them in the market. But there's a higher demand for these high-skilled jobs, therefore could effectively push wages down, but also meaning that they will remain unemployed for a longer period of time. And this scheme pretty much targets the opposite. Instead, they're targeting the young people who are likely at the start of their careers. And what I've noticed is that entry-level jobs seem to still be around. At least in my town, around 60% E4 of pubs and restaurants are actually hiring. This could be very short-term or very limited perspective due to my area and where I live. But this means that younger people could easily find a job, at least in my area, in a pub, bar or a restaurant. I just don't openly see the demographic of those in high level of employments actively taking up entry-level jobs. And therefore, what I see is a split between the balance, effectively meaning that unless these higher skill employees take entry-level jobs, that this is going to remain quite a high demand area. And therefore, it shouldn't be very hard for young people who typically are going into these entry-level jobs like pubs, bars, cafes, warehouses. Therefore, it shouldn't be difficult for them to find employment in these entry-level locations. But I feel that it doesn't really benefit many young people, nor does it benefit the high-skill employees that are stuck without a job. But what it does benefit is perhaps university students who have perhaps just graduated into possibly the worst recession of our lifetimes. And they're just like, well, I don't want to get my hands dirty. I don't want to do groundwork. I want to get an immediate graduate level position so I can immediately progress on my career path. And honestly, I don't blame them for thinking like that, because that's exactly what I would be thinking if I was in their situation. I would rather not be working in a pub, bar, or any of these jobs, especially after studying for years. I would likely want to start a position in the desired career path of my choice. But to me, this means there's going to be a large divide in the job market, in which there is an imbalance between entry-level jobs and high level of skill required jobs. And therefore, I still think our economy is going to be damaged by this, simply because the discretionary spend of young people is likely going to be a lot less than the potential discretionary spend of those that have been made redundant on higher levels of employment and subsequently likely higher salaries. And therefore, since there's less discretionary spending, I suspect that the economy will still struggle, especially as our economy is primarily built up on hospitality and services. Higher paid employees would likely be spending more on. I'm really impressed with how the portfolio has held up this week, as it's especially been a very volatile week in the markets. Unfortunately, we seem to get caught on bad timing with the American markets, and every time the FTSE is zigging, the American market is zagging, and therefore we cross out. And effectively, what usually happens on a week-to-week basis is that as the FTSE is doing quite well for the day, perhaps up 1 or 2%. The American market then opens, has a really slow morning, forcing the FTSE down out of sentiment, and therefore will likely close in the red, but then as the day goes on, the US market regains confidence and they finish on a high. But this effectively means, at least on weekends, each Friday, it's very likely that if the US market opens low, we'll get stuck and we'll get trapped and we'll open low, and then they might finish on a high, therefore leaving an imbalance when looking at the short term. But then this is also combined with the low sentiment in investors currently, and that's due to the uncertainty of Brexit, the pandemic, and whether you'll subscribe to the channel, as it's free, doesn't cost a penny. Thank you. Since a lot of the US tech stocks have had a minor correction of roughly minus 10%, the lack of sentiment also flooded into our FTSE markets and actually pushed stocks down that perhaps didn't need to be pushed down, and therefore there is an excellent chance to start nipping up some bargains, although I advise, or I would personally suggest, that you don't just put loads of money in now buying because you think, wow, stocks are like 10% cheaper, as potentially it could go lower. So if you're thinking about buying stocks now, perhaps put half in now and give it a month and then put another half in. For example, just average into the market, as you could get nipped on a falling knife. Anyway, this means in the last week, the FTSE 100 is down by 2.93%. The FTSE 250 is down by 2.5%, and my portfolio is only down by 0.31%. And whilst you may think, well, your portfolio value is up this week compared to last week, that's simply because I've deposited an additional £300 and I've actually bought up some stocks at a nice little averaging down price. And actually, I see this as an opportunity for UK investors. Yet again, where our stocks are going down, and currently there's a lot more risk and uncertainty priced in the FTSE, and therefore I see a lot less potential downside, as currently it feels like it is priced for Brexit to go terrible, our economy to struggle for years, for the pandemic to not fully recover for years and all. So it does feel like, whilst the American market is very pumped, overinflated, near bubble levels of territory, our FTSE market being down 20-25% means that there is more of a logic behind the market, and therefore we may have a slower recovery but have less risk of an immediate crash, at least until the end of the year. And that's why I'm actually not building a cash position to be that big. I'm effectively averaging in pretty much every week and just deploying that cash to build up my positions, so that after the new year I can then build up a cash position. An example of this would be Games Workshop, which is what I currently believe to be on a 40-day low, as they've dropped 7.8% in the last week, and I'm not really sure why. Obviously, there is the common idea that not all short-term market movements are related to news or substantial changes in the business, but rather they can just happen randomly. But what I'm seeing here is a good buying opportunity for this stock. It is now priced at a PE ratio of less than 40, and to you that might sound like a premium, but this is a very well managed company that justifies trading that high, especially because they believe in creating shareholder value, not by purchasing other businesses or demolishing their own, but by rather just consistently investing in the businesses that they own and making them more profitable. But what I see is that this stock has dropped, as it has got online ties such as royalties, in which they sell their brand of Warhammer to various video game companies, for example. But the revenue of royalties is £16.8 million compared to the total revenue of £270 million. Also, the management is excellent because they had decided to reduce the dividend this year. And you might be thinking, that's not good. As a shareholder, I want my dividend income. Well, they didn't reduce it by much. They literally reduced the dividend from 155 pence this year to 145 pence. But this also means that they've deployed a new strategy in which they will now hold a 3 months capital expenses emergency fund in cash. This puts the business in a very resilient position for any future potential problems, and therefore after this time they can then put more of their surplus cash back into their dividend payments, in which they usually aim to put as much surplus cash as possible and return it to the investor. And that's why I like this stock. It's a nice income giver, and currently my allocation is only 21.7%. And honestly, I'm very tempted for this in the future to be one of my biggest positions, if not the biggest. With the market turmoil, I actually managed to purchase some more shares in Ashtead Group this week, since they've dropped around 7% since around the 24th of August. I have simply bought more shares in this company because I believe the markets to have severely undervalued the company, and I believe the company's business model, Ashtead Group's or Sunbelt Rentals business model, is a lot more resilient than the market believes. And therefore, I feel that on their Q1 results and AGM on September 8th, that they will have results better than anticipated, and therefore we'll see a subsequent rally in the share price of the stock. So ideally, I'm going to be buying more of the stock before that date to therefore make use of that increase in share price and what I believe. But what I will be doing is potentially slightly overexposing myself to this position, as currently it's at 9.8% out of the desired 10% target allocation. But what I might do is bump up to 11 or 12% and then let that ride over the medium term whilst I build up the other positions. But since I've purchased 12 more shares of Ashtead Group this week, that gives me an additional £4.88 of yearly dividend payments each and every year. And this assumes absolutely no growth. And Ashtead Group have had fantastic growth on their dividend. I'm going to temporarily make myself overweight in this position and then look to building up the next stock on my list. And that stock is actually Softcat. Softcat are a company I have very little equity in currently, but they share a very similar business model to that of Games Workshop, in which they want to return as much cash as possible to their investors. And Softcat is a company I've spoken about in the past simply because they had rallied such a significant amount over the last 60 days. It's now dropped back down to quite a nice reality, and this is a resistance I've seen fairly often, and it may be time for me to start building this position up. But since they are also a highly cash generative company, they aim to have around 40 to 50% of profit after tax, and they redistribute that to their shareholders. This is the type of company that I love to own. This may mean that in the future that they have less growth potential than other companies, although they're in a sector I believe over the long term will continue to do well and grow. But I love this with Games Workshop and Softcat because they regularly distribute a lot of their surplus cash to their investors but still continue to grow. Perhaps in the future this may mean there's less growth potential, but at that point I'll be siphoning the dividend income and hopefully being financially independent. And I would rather not that when I'm retired to worry about selling 4% of my holdings each year, as I'd rather just buy and hold these stocks for life and then let the dividends do the rest. And therefore you may be saying, well, you own Boohoo. Boohoo is the exact opposite of an income distributing stock, so why are you holding it? And honestly, you've spoken too much about Boohoo, so make it quick. This is true. This is not what I'm looking for in a stock, and therefore it is a shorter term hold than that of my other stocks in the portfolio. However, do not misinterpret me. When I say shorter term, I don't mean I will be holding it for a few weeks, a few months, or a few years, but I plan on holding it for a shorter duration than that of my other stocks, which I would consider to be extremely long-term holds. What I will likely do in the future is take profits from this stock and then reinvest it into a more income or a more cash distributing stock and therefore benefit that way, but therefore giving me the younger ages to benefit from the high growth potential of the stock. Whilst yes, they are planning to take 150 million from the company and give it to the directors if the share price hits £6 per share, it's not really looking to reward shareholders, and that's why in the future I will likely move away from this stock after I've gained a decent sum of profits. This week there was an annual general meeting for Halma, and therefore the main topic of the video, as therefore I'm going to break it down what an AGM is, how you can use it to your advantage in the market, and what it really meant for Halma. Unfortunately, due to the virus, their AGMs produced by many of the companies currently aren't what you would typically expect. Typically, you would have shareholders or very important people that are invested in the company sat in the crowd. They would be there watching the board as they give their answers. And typically, there would be questions from the shareholders in which they'd ask about various different things. There would also be a voting process in which this is done beforehand, and therefore each share is equivalent to a certain number of votes. You vote towards certain things like the final dividend. Do you want to be paid that, or do you disagree with this decision? If you disagree, you would therefore vote against. Before showing the first questions, I should really explain how Halma works as a business. Effectively, as a business, they are able to generate high cash flow, meaning that they're able to have low capital expenditure and therefore high rates of returns on their investments. And this means that one of the most effective ways that they use their capital or cash is to acquire other businesses, in which they would purchase another business, therefore use their size, scale and scope to their advantage, therefore making the new business that they've bought more profitable and cost less to run, and therefore they use that money to purchase more businesses. And therefore that capital is used in a process called mergers and acquisitions. And this creates a cycle in which the process is repeated, and therefore with the money that they've made from their recent acquisition and all the other companies they own, that capital goes towards purchasing another company, and this creates such a long cycle which compounds their growth over time and therefore dominate the industries in which their businesses are in, or even start joining other industries and compete there. Therefore, the shareholders of Halma, as a majority, have asked if there has been any activity in mergers and acquisitions on the first half of the financial year of up until the 31st of March 2021. They've responded by saying they've not completed any mergers, any acquisitions on the first half of this financial year, but they do plan to resume this in the second half of the year, which in my opinion is actually very good news. This means that they can likely continue purchasing businesses, but businesses that are perhaps struggling due to the pandemic. And whilst morally this could be a bad thing, Halma could be like reaching out to them, offering them money so they can continue to survive as a business, but working under Halma. Therefore, Halma has a stronger hand when looking to negotiate and purchase various different businesses. Something you don't want your company doing, however, is increasing their debt rapidly during this time period, as it very much adds a lot more risk to investment, as if the company fails to generate successful profits, therefore they're going to be struggling to pay back their debt that they've got, and therefore this could lead to bankruptcy of the company. Since Halma is regularly acquiring other businesses, this does mean that they will be taking up debt, as when you acquire a small business, they very likely got debt, so that debt is added to the total debt of the company. So this means it's very unlikely for Halma to become debt free, and therefore will consistently always have some debt on their balance sheet. However, shareholders have asked about their gearing, which is effectively their net debt to their net income, or more simply, their debt to equity ratio, and that Halma has a target of 2 times. This means that they would like 2 times more debt to their equity, and they will not go further than that. And currently, it's only at 1.1 times. This gives them quite a bit of scope to therefore purchase some companies in the second half, especially because they have a fairly strong cash position, and therefore they could substantially grow during this period. Although, however, if they do not purchase any more businesses for the rest of the financial year, then they've said that this gearing ratio will actually lower and they will look to paying it off further. Other than a Q&A, there is usually a voting process in which I've explained earlier, shares equal a certain amount of votes. And pretty much this means that you could vote for or against certain decisions. You might disagree with the auditor's opinion on the finances, and therefore the clearest way for you to show this to the board is by voting against the report on finances. And therefore what they will see is perhaps 40% voted for the auditor and therefore 60% voted against it. Therefore the board might be able to clearly see, right, we need to look, or we need to focus our attention into the finances of the company. You could also use this to reject certain things, like perhaps the CEO gets a pay rise of 20 or 50%. You think this is ridiculous because he hasn't actually done much that justifies a 50% pay rise, therefore you could reject it. However, the board are under no obligation to follow this, but it's most likely they will comply simply because they want to keep investor sentiment high. However, for us using commission-free brokers and many of the brokers in the UK, your assets are held by a nominee. This means we have no power to vote. Hopefully things update further and we would be able to do so, but for the time being we cannot. The highlights of the votes are that 99.98% of people agreed with the final dividend payment. Obviously it is a dividend growth company. 96.43% agreed to giving Halma the authority to make political donations. 98.62% gave authority for Halma to initiate their buyback scheme, in which they're going to be purchasing back their own company shares, therefore decreasing the overall supply and subsequently increasing the price of each share. Interesting, the most controversial decision was actually an 88.46%, which they voted for the remuneration of Tony Rice, which effectively means keep him on the board. All other board members were above 95%, and so it was interesting to me to see him being this low. Although I don't know anything particular in this because I am not that well researched into Halma to a board level. But if you know the answer to this, please leave a comment down below, as I'm very curious as to why investors may not like Tony Rice. The share price for Halma is the lowest I've seen since the start of May. This could present a buying opportunity, but in some opinions, it could be considered overvalued. I've personally bought 3 more shares and I will look to average down when possible, but my priorities are Ashtead Group, Softcat and then Halma. but we'll see as time goes on. If you're still interested and you're interested in my UK undervalued stocks to buy, then click the card at the top right of the video. This is the Ozbourne Foreman Show. Thank you for watching. Stay safe.